Okay, here we go. Hey everyone, how are you? This is Dara Albright with Keep Small Biz Alive. I'm really excited to be here today with Pelli, Wang, and Mike Wasyl of Deer Creek, which is a FinTech services firm. Today, I think we're going to cover a really important topic, exciting topic too, and it's really kind of why FinTech has been able to really jump in and expedite a lot of these PPP loans for small businesses and doing it at a much faster pace than conventional, banks have been doing it. So for that, we're going to have a great conversation, a lively conversation, and why don't you guys start, introduce yourselves, talk a little bit about Deer Creek, and then we'll jump into some questions.
Sure, Pelli, you want to just give a little bit of background about yourself, and then I'll do me in the company.
Hi, everyone. My name is Pelli Wang. I'm one of the managing partners of Deer Creek. This is a company that we started about a year and a half ago, which is a spin out from Consensus Capital. My background has been always at the intersection of finance and technology. So I started working in more traditional finance at Barclays, in their investment bank, servicing private equity firms, and then moved over to private equity before ending up in early stage startups, and also doing a lot of work in the blockchain space, which is how Mike and I came together.
Great, thanks, Pelli. Yeah, so Pelli gave a good start. My background, again, is in FinTech. Mostly started my career at Bloomberg, where I worked as an analyst and client-facing in a company, at a division of the company called Bloomberg Vault, which we did forensic trade reconstruction compliance. Just kind of seeing the inner workings of how trades went down. I got involved in the blockchain space in 2016, mostly in the Ethereum community, and then moved my way to Consensus, where I worked with Pelli on the capital team. We were responsible for sourcing and running business development for the ecosystem, including the Token Foundry team, when we were exploring that in the early days. And then, further than that, we were basically working with enterprises, banks, and other institutions to try to implement, the newest fintech technology at the time. We really focused on Ethereum and blockchain. But yeah, Deer Creek, as a result of that, we spun out, and we created a firm that focuses on fintech and bringing it to those who need it the most. We felt that a lot of the firms were quite myopic about technology. We wanted to create a technology agnostic approach, and we've really teamed up with a lot of new companies that are emerging from the fintech space to offer their services to the market where no one else was. And we're seeing a lot of benefit from that. And we also manage special projects as part of the company as well.
That's great. Thanks, guys. And really, thank you for being here. So let's jump in a little bit to some of the questions. First of all, what really inspired this particular conversation and discussion with you guys was that when we had started the Keep Small Biz Alive, kind of this network and this group to basically, put these communities together, get small businesses to come together. What we've been finding with some of the people posting, some of the struggles that they're having with obtaining PPP loans. And I know that many of them have been going to their, major banking institutions, conventional banks that they've been working with over the years, the Chase, the Cities, et cetera. One of the things I think is interesting that we've started to see is a lot of the community banks really stepping up, and we're seeing that just especially because there is so much demand and such a big undertaking that we're actually seeing something really interesting happening, where you're now seeing some of the private lenders and the smaller community banks really stepping up and expediting some of these loans faster, or giving the ability to access the money faster. But then I was curious, because you're also starting to see a lot of the fintech companies now step up. I think they weren't able to in the beginning. You have to get approved. But now we're starting to see some of the fintech companies step up, FinTech Lenders. And my first question is, how and why are FinTech lenders able to expedite these loans so much faster than conventional banks?
So I can start there, then Pelli, you can chime in as we go. I'm sure I'll miss some things, but I think it's best to frame this by saying, why do we even need to talk about alternative lenders in the space, as opposed to what people are used to, which is going to their bank or going to a community bank, credit union, whatever, to try to get a loan. And over the last decade or so, small business lending has been difficult. It's contracted significantly since the last recession. It never quite recovered. Small business never quite recovered. That C&I lending never really did. And it's becoming less and less a bulk of the total every year, which was, kind of alarming to begin with. And the trend as a result of that was the emergence of alternative lenders, online lenders, for consumer and for business, who were stepping into this space with more efficient onboarding. They reach customers in a much better way. One important element of why those alternative lenders more or less took foothold in that space is because they were able to efficiently onboard new applicants and quickly process their information. And they do so by, digital means, connectivity, and other ways that banks really haven't caught up on. And that's really been a primary reason why we're seeing the alternative lenders step in here. And over the last several years, while there's been obviously some difficulty from some of these lenders who overextended DTC e-commerce brands and others, the clear message being sent is that if companies can more efficiently, or if alternative lenders can more efficiently reach customers, more efficiently lend, can leverage data that they already have from platforms or other areas with data connectivity, they can definitely speed the process up and help bring on new customers. Now, if we're talking about community banks, unfortunately, community banks have over time have kind of been consolidating, right? It's been a pretty significant consolidation year over year, about 5%. And what that means is basically the growth in that industry in smaller banking, we're talking like, under 30 billion, under 20 billion, even, community banks much smaller, even those banks and regionals have been consolidating, and that's the only growth mechanism they have. So when it comes to helping customers, the technology spend has been a historically low percent of their overall spend. Maybe Pelli, you can get into that a little bit more.
Yeah, so I guess if you look at sort of the underwriting process, that is pretty much the same regardless of how big a company is. So a bank has to take a look at who is the borrower, what business are they in, what's their business model, how do they generate revenues, and as a bank, if I lend $100,000 or $100 million, what is the likelihood that I will recover that capital back over X amount of time? So that process hasn't really, in terms of efficiency, hasn't really improved for banks, which is why a lot of the banks that have consolidated have moved up. So if you look at JP Morgan's and the Goldman's, they can focus on really big institutional customers with really complex deals. They can put a lot of very expensive people to work on those, and that makes sense. But at the smaller businesses side, that part has been kind of left behind. They haven't really invested a lot of technology to look at that, and they didn't have the connectors, say, to look at, okay, how much is this business generating on a daily basis if they had those payment processes available. And that's how we see alternative lenders like Square, because they're at the point of sale. They can see, okay, this company, this month or this quarter has generated this amount of sales. If we, decide to lend against that and we can sweep that cash back, then that kind of delevers our risk. And that's kind of some of the alternative data sources that these lenders have started to incorporate, where they can sort of de-risk their investment and get money out to these companies faster. And that's how they started to really gobble up market share.
That's really interesting, because that was actually going to be my next question is, the data and what kind of data are they looking at? And it's interesting that you say that, because they have access to a lot of data that traditional banks don't have access to. Are you seeing traditional banks now? I mean, so many of them must be so busy and so overwhelmed because of this. Are they, since they're not using technology, they have to use people. So have they been hiring? What's been kind of happening there?
Yeah.
Yeah, Pelli, why don't you lead that one? I think you probably have the best
Yeah.
perspective.
So I think for, big businesses, that's an area that, people are realizing that they need real-time information, right? So with travel down, like 90%, people, that have traditionally lent to airlines are saying, how does this impact, what does your business look like? How are you covering your expenses? And traditionally, people were just getting, those monthly statements from the accounting firms to be like, okay, this is what, this is what's happening on a month-to-month basis, but they actually want to see more granularly, how does this impact on a day-to-day basis, right? And with technology, you can see that, even, down to like hour by hour, just to see like how are sales doing. So that part, I guess, for big businesses has not historically changed, but because of the speed at which people, especially if you're in commerce, if you run a campaign and you see that's effective, that's driving sales, then from a banker side, that's really valuable information to have and to see.
Right. And on the people side of this equation, because this came on really quickly, given the shock and awe of COVID-19 and kind of how it hit the banks, they only had a limited number of seats to enter these loans into the e-trans system, which is the SBA's government, database. So what ended up happening was some banks did have digital lending processes, right? The bigger regionals had them, some regionals had them, and some of them aren't that great either. But ultimately, the banks that did have digital lending, that's great. They can capture information quickly from customers. But the problem is they have to funnel that to the SBA for government loans. So while banks are still making 1% on these loans, they're relying on the government to process them. So we saw today, I think 185,000 outstanding loans from Bank of America are waiting to be processed from the SBA, I believe. And that's shocking just to see the difficulty there. I mean, even today we're trying to get in touch with the SBA for a number of things, and hard to get in touch with them. They're busy. And I think the problem is, we had a limited number of seats at banks that could process information, or that middle office, loan officers, as well as like a limited technology toolkit to be able to process the influx. Now that's kind of where we see the opportunity here in the market and for the fintech guys, because I mean, if the fintech people are licking their chops right now because they know that the next gold rush in this space is going to be effectively and efficiently lending to SMBs who are at a historic need for lending. And that was before the crisis. That was rising. Those numbers were rising. And now the crisis comes in, and we're going to see 50% of SMBs needing money. I mean, and that's including some technology firms. So that's quite incredible, and that's where we're headed.
It's interesting. So what you guys are saying, that fintech is able to really expedite the loans, and there's the advantage there. But how about in pricing? Are you seeing differences there as well?
Yeah, I mean, we just kind of went through a process of comparing rates for a lot of these lenders, and they can be quite aggressive. A lot of the rates aren't necessarily the best for the digital lenders. That's just because they can be more aggressive and come in hot and make the process extremely efficient. So it is quite true to your point earlier that community banks do come up big sometimes and offer better rates. So that is not necessarily the selling point all the time, but the accessibility of the platform and the capital can be done in a few minutes. Yeah. So people are willing to just do what they can to get the money now, instead of potentially waiting up over a month to get money for certain circumstances, not just these SBA loans, but even beforehand. I mean, some technology-enabled banks are able to underwrite small business loans in a few minutes, others weeks. And there's a humongous difference between the banks that can and the banks that cannot, which is going to fuel this ever progressing consolidation, because technology-enabled banks are just going to swallow business because they're so much more efficient. So from rates perspective, we're not going to get down in the weeds, but it's not necessarily true that the online lenders have better rates, because many times they don't. It's just that they're so much more efficient at accessing and delivering the capital.
Interesting. So could you talk about some of the fintech lenders that are out there that maybe that could be helpful? You even give some guidance there.
I think the first place to start, which might be really cool, is a slightly different angle. So what we've been seeing is a really strong component of this market that people are not paying attention to. They should be. is the payment platform businesses moving into lending. Now, this has not been this is not brand new by any means. Like PayPal has been in the lending space, working capital loans for a while. However, it's accelerating rapidly, and the competition is accelerating rapidly. We saw PayPal reach 10 billion plus in lending recently. It only took them 5 years, right? Probably, I think 5 years to get to that level. And then we're seeing those like Stripe and Square who already work with many of these small businesses anyway, on their working capital, or sorry, on their their payments infrastructure and merchant accounts. They already work with them, so they have access to your data already, and they could already pre-qualify you for loans right off the bat. And many of them are offering these loans at reasonable rates because while they're unsecured in many cases, I think in most cases they're unsecured. They know your data payment history over a certain period of time, and if they extend a loan to you, it is they know more or less what's going to happen. And that's the advantage. I think a lot of folks in the market right now would really do well paying attention to, if they use payment processors, merchant services, to look at the offerings they have, because they have your data. There is another element to this. The relationship lenders, that's great, right? People love a good relationship, and that's how a lot of these banks keep customers. But 48% of millennials are not going to community banks to get loans. So what is that telling you? That's increasing. So they have to, they really have to pay attention. The banks have to pay attention to those who are, closing the gap as far as efficiency, which is the number one concern for underwriting these loans. So I would say to anyone out there, you should go to your payment and merchant provider. Look, if you're not eligible for a PPP loan or something like that, and you can't get it for whatever reason through your bank, or you're having trouble getting one, you should also look at your your payment platform and see if you can get a working capital loan quickly, really quickly, in the same day many times. But Pelli, maybe you can touch on like Chime and some of the others and how they've kind of started to adopt maybe some of these.
Yeah, so we've seen a lot of, in the last few years, there's been an incredible amount of VC investment into neobanks, right? So banks that only are digital first, they don't have any retail presence with locations. They first started with consumer accounts, and now they're really pushing hard into business accounts, because they realize that, hey, if you're individual versus a business, like a lot of times people are so mobile and on the move, so you might not be always doing business in your original like headquarters. You might be traveling to other regions within the US or even abroad, and having a tool that is a really smooth onboarding process with low fees is a way to sort of win customers. And so we're seeing a lot of those companies get very aggressive with great online campaigns, and they're starting to win a lot of those accounts, because again, the traditional banks are very slow. They don't, they're inundated with applications right now, and I think from what we've heard is that they are first prioritizing people that they have prior existing relationships with. So if you don't have a bank account, you're pretty much at the back of the line, and they're probably not going to get to you. And perhaps there's also, even within the relationship sort of queue, people that have bigger accounts with a bank will most likely, I mean, they're saying that it's a first come first basis, but we're getting a sense that those bigger accounts are getting prioritized first, because obviously the bank knows that they're an important client. They might have big loans against them. So if they advance, a PPP loan, they know that that will help cash flows in other areas. So, if you're a smaller, relatively new account, then you might get left behind, which is really unfortunate that this is kind of happening.
Yeah, and one more point to add, just to kind of cap this all off, is that beyond the business banks that are coming out, the neobanks and that are digital first, the kind of leading alternative lenders like Cabbage are offering PPP assistance. They're a lot of those like Cabbage and Cabbage competitors are with a K, Cabbage, Kabbage.
They're Atlanta based.
Yeah, Atlanta based. Yeah, they're great, but they offer loans, under $250,000 generally, really fast to small businesses, which has been amazing. They've been growing quite well. I mean, they all have had trouble. All the alternative lenders have had some trouble recently with, on deck. All these companies have had some trouble with some companies collapsing, right? Some of the e-com companies collapsing and not being able to make up payments, so losses are there. But as Cabbage and others move into the PPP space, I think they're approved now to do it. They're able to offer it much more quickly than a bank in many cases. They can process loans, I believe, up to $2 million. Many of these guys, I think Cabbage can. So that's definitely someone to look into. I don't think there's any prioritization queue based on your account, which is kind of an old school approach. I mean, yes, relationships matter in a smaller community or even in a regional bank, and they should matter, and they're centered to a lot of, long lasting relationships. But if we're talking about just the speed at which you can make a decision, unfortunately right now the online lenders are probably going to have the better hand in being able to make those decisions much more quickly.
So I think it's really interesting, when talking about this, and this is great. I mean, thank you so much, because I think you gave really a lot of helpful advice for people, to really give them a starting point of where to go to. But what's interesting also, and I would love to get you guys' perspective on this, is what does the future look like? I mean, we see that within all of these crises and, in the past, and, different market turmoils, et cetera, after, really online lending kind of emerged even out of the 2008 crisis. So are we looking at now the COVID crisis sort of in a different way? I mean, is this really the chance for FinTech to kind of shine? And is that really going to prove that this is the future? And if so, what does the banking landscape look like in the future? I mean, does this expedite? I mean, I think I'm someone who advocates for FinTech. I think that this is, obviously the future of finance. But maybe because of this crisis here, we're going to see that really sort of expedite, and more people get to know the FinTech lenders, and maybe even see a lot of consolidation in the banking industry. I'd love to hear your thoughts.
Yeah, so our vision is pretty clear on this. We're really helping make this a reality as well in our own efforts and our own projects. Is that as far as the lending space is concerned, there's two things, as we discussed earlier a little bit, that are happening. Consolidation over time. 5.5%, or I think 4 to 5% year-over-year consolidation in regional banks and community banks, with community banks bearing the brunt of this, small community banks bearing the large brunt of it, unfortunately. So that's happening. And then at the same time, we have a 7.7% compound annual growth rate of online lending, which right now does not make up the bulk of lending to small businesses. In fact, large banks actually lend the most to small businesses, contrary to popular belief that they're like the primary lenders to small businesses. Yet, the rest of the market is split, regionals and community. However, what we're seeing and what we want to move toward is this accelerated, what we're seeing because of the event, but an accelerated phase of consolidation, which will occur over the next couple of years as we see the effects of this crisis, really come to play, and the effects on the macro economy, whether they're inflationary or whatever happens. We're going to see the impact on the local bank. The banks that can survive are the ones that are going to transform their experiences into primarily digital experiences. And if they do have a branch or a personalized location to come to. Some of the best examples we've seen have been out of Seattle. Like some of the community banks there have transformed their teller window kind of experience into more of an open layout, where it's kind of like a Starbucks. It's like you come in, everyone's armed with digital tools, with iPads, and they can still talk to you about it. I mean, it's hard to get $1 million loan online. We get that, so we do think the role of a bank is still going to be there. It's just going to transform into a digital first experience. It has to. So where FinTech comes in now, what we're trying to go towards is this enhanced connectivity, because data is going to be the key component here. Alternative credit data is really important. Is now, you can actually use it compliantly to generate a better picture of someone's creditworthiness. That includes, alternative credit includes a lot of things like, student debt, liens, anything. It goes far as looking at, past business history. We're an advocate personally of looking into, eventually looking into and connecting to business accounting systems, such that we can see, or banks can kind of get a picture in real time of what that business is doing, and make a more informed decision based on their risk profiles that they want to put into their models. We think that all should be very fluid, so they're not locked up in paperwork or manual data entry. We're seeing right out of the data that younger people, millennials, and even into their even into the next cohort, the Generation X, will drop off of these like from the data. They'll literally drop off the application because it takes too long. That's one of the primary reasons why they drop the applications. So if you can expedite the application through data connectivity, you can win more customers at first look, right? Because in no way have alternative lenders owned the space. They're moving towards that direction fast, but they're not there yet. And I think banks still have a foot to stand on in this space to maintain market share. The problem is they really have to embrace technology and have to get over their over the hump, if you will, about spending on technology, which is historically a low percentage of their overall spend. It's usually very human capital centric, and at the cost of one human being, one salary position, you can bring on technology that could potentially add millions of dollars of revenue to your business. That has to be the thought. A lot of CEOs of forward-thinking regional banks are now starting to think that way. But for us, we need to see, and we're trying to push towards that direction. Pelli, what are your thoughts?
Yeah, I mean, historically, again, a lot of the local banks were relying on their relationships because they know people have cash, so they need to like deposit them in the local branch. But as more and more people start moving to electronic payments, cash is going to be less used in the economy. So, people are going to care about, well, can I instantaneously send money to my supplier in Asia, and I want to not have to pay a lot of fees for that. I need that to be, 24/7. So those types of services will become more and more important. And, being able to see all of your banking information connected into some dashboard, those are going to be very important sort of features. And that's kind of missing from the existing companies because there's so many things that they have to upgrade their systems over the last 20, 30 years. A lot of them are still using very, very old infrastructure. They have not adapted to sort of this like new online kind of world that we're living in. And this like COVID experience has realized like, wow, if we really cannot get to the branch, then we need to still support our customers.
And I guess that's where blockchain comes in
Yep.
too, because when you're talking about, transferring money instantaneously, now we're looking at utilizing blockchain and cryptocurrencies, and that's a conversation for our next one. But yeah, it's amazing. It's almost like, as you guys were talking, I'm thinking it's like we're in a period right now where we're going from the abacus to the calculator. It's
in many ways. Yeah, it's that way for the infrastructure. I mean, many banks are investing in, there's some complex infrastructure and quite sophisticated infrastructure out there, like offered by FIS, Fiserv, Jack Henry. There's a lot of products out there. However, a lot of our community banks, regional banks will listen to their core providers because they have 7-year-long contracts, 5-year-long contracts to support all of their services. And those systems were built in like a stacked, kind of a stacked way instead of the modern way, which is cloud-based, modular, composable, microservices architecture. A lot of these products that are coming or that are already in regional and community banks are just not designed like that. They're not designed for that. So we're looking at, for us, we're looking at a lot of these companies that are designing composable banking infrastructure for the new wave of banks, and for banks that want to update their world, so that they can plug in systems that are designed for change, which is what you have to do instead of, exorbitant spending once every 10 years or whatever to replace it. That is definitely the way that we're going. And we think, as far as blockchain is concerned, just real quickly, not to dive into that, but where blockchain works is not only for easing the transfer of payments and things like that, but also security as far as data is concerned,
right.
Giving that back to the individual such that they have control over it. So that's a whole different topic, but I think there's a lot to look forward to for the forward-thinking banks and the forward-thinking organizations, that they can still compete with online lenders because they're in a better economic position in many ways because of their balance sheet to lend. So, to me, they can still compete with online lenders and provide a really great service. It's just a matter of who's going to adapt the fastest. And that's really what this COVID thing is asking us to ask ourselves.
It's interesting, and that leaves us off at a great point, because now we know where we could start off next time. We could go into doing this again, focusing on the blockchain side of this. But this has been really enlightening. I thank you guys so much. And how could people get in touch with you?
So our website has our contact information, deercreek.io. And you can reach us directly through there. That's probably the best way to go, and we'll get in touch with you immediately.
All right. Thank you guys so much. And thank you everyone for tuning in.
Thanks.
Thank you.